So I tweeted this out the other day. I said, read this article carefully and then examine Lemonade's lifetime value to customer acquisition, or LTV to CAC, unit economics, and then invest accordingly. It could make you a fortune. Not financial advice, of course. So in this video, I want to dive into what this article says and really explain it, break it down in more detail why this is important for Lemonade. And this article was shared by Pranav of General Catalyst, which was an early investor in Lemonade and is now the funder for their synthetic agent program. So this is going to help you understand, I think, some of the ways, a key way that Lemonade is misunderstood. And if we as investors understand this really clearly, it can make us confident in the Lemonade investment into the future long before the rest of the market is going to see it or understand it. So I'm just going to read through the article by Pranav. It's really, really great. Give some highlights here and then also give my further commentary. But he starts off, the main sort of thesis here, summary or point of the article says, tech companies severely underinvest in growth due to two reasons: a P&L, profit and loss constraint, as there's investor pressure to show a higher EBITDA, even though the metric is not relevant for most tech businesses, and a balance sheet constraint because they want to preserve cash near term, even though the growth spend has a good ROI long term. Both of these constraints severely hurt long-term enterprise value. So we need to rethink the framework around this for our businesses, or especially a business like Lemonade. Because the key thing I want to hammer home in this video is that if you spend more money on marketing right now, more money on growth, more money on acquiring new customers and making a cohort of customers bigger and larger, you're spending that more money right now. That's going to hurt your P&L. That's going to hurt your EBITDA. It's going to hurt your net income right now in the present quarter that you're posting earnings about. It's going to make the company in some ways look worse now, especially for a public company. It could hurt the stock. It could hurt all those things right now because you're growing, you're investing more into the growth that's going to pay you back down the road. Now, if it has a good lifetime value, if you're investing in customers that are going to have like Lemonade says, and what I've calculated, they have at least a lifetime value of 3 to 1 LTV to CAC or higher. If you're still continuing to invest in that kind of unit economics or better, then you should keep investing. And the only reason companies don't is because they want to look better on the quarter that they're currently in. So if you invest $1 million more in marketing, well, it's going to hurt your bottom line, your EBITDA, by $1 million. Then if you hadn't, it's going to make the current quarter look better, but quarters down the road not look so good because you're not making that investment that you should be making. That's essentially the whole crux of the article, but we're going to look at it a little bit deeper here. So he says, this was really, really interesting, is the origins of EBITDA. Why does EBITDA use as a metric to begin with? Anyways, if you're not familiar, EBITDA is earnings before interest, taxes, depreciation, amortization. So before you subtract all these things from your earnings to get a net earnings, this would be your earnings before all those things: before interest, before taxes, before depreciation, amortization. And it's a more relatively new concept. I think it was sort of pioneered in the 80s by a John Malone, who was running a cable company, giant TCI company, I guess. And essentially, cable businesses, they're expanding their cable networks. They're spending tons and tons of money to build out cable infrastructure. And it showed massive losses because you're making this huge investment, and that's showing up on your P&L as depreciation. So there's a ton of depreciation happening as you're continuing to invest. And then your cable company, as you own a market and own all the infrastructure in a market, of course, you're going to have people sign up for cable. And then over the next decades of time, those people are going to pay you back handsomely, and you'll get a great return on all that investment you're making. But I think this John Malone, people were not understanding the sort of unit economics of the cable company and where it was going. So he really pioneered or championed this EBITDA metric to say, hey, let's look at the earnings before we subtract the depreciation amortization, and before you subtract your depreciation, it's going to make the earnings look a whole lot better and give investors a more of an idea or picture of, hey, this is what we could be earning if all the depreciation was done with on all this infrastructure. So it sort of shows what's your ability to generate cash. So that's sort of an interesting origin story of where EBITDA has come from. But for tech companies, it's funny because EBITDA, as Pranav points out here, more than half of the letters have zero effect. Half the letters in the acronym have no effect on tech companies. They really have almost no debts. There's no interest being factored in, or very little. They make ongoing losses often because they're investing into the future still. So there's no taxes you're paying, and they have no real assets. So there are very few buildings or physical assets. So very little depreciation amortization. So it's not the most helpful metric necessarily for tech companies, or even a company like Lemonade, even though it's still commonly cited. And then he goes on to say, you really should think about this as not EBITDA, but EBIT CAC, meaning instead of your depreciation amortization, say for a cable company that's spending all this money on capital expenditures to grow out your cable infrastructure in a whole, nationwide infrastructure spend, a massive spend. Instead of that, you should think about it as your earnings before your customer acquisition cost, because a company that's structured like Lemonade, your main cost is not rolling out that physical infrastructure, but rolling out marketing wave after marketing wave after marketing wave of buying and acquiring new customers across the country to join in cohorts of customers that stack onto each other again and again and again. So especially in business to consumer companies like Lemonade they spend a much higher percentage of their total OPEX on the customer acquisition cost because they're going directly to their customer. So they're doing all the heavy lifting of spending that themselves to acquire those customers. They're not even necessarily using, as other insurers do, who rely more on agents who would have less expenses showing up there, but then they would be sacrificing more of their rewards later on. So a company like Lemonade is spending a lot on customer acquisition cost. It makes sense to think about that customer acquisition cost as a major investment into the future that's going to drive returns. But when a company is managing to a target EBITDA, like say you're trying to say at all costs we must get to break even EBITDA, we have to get to positive EBITDA, no, it doesn't matter, then a place they're probably going to start cutting is their customer acquisition, sales, and marketing. And if you have a good LTV to CAC ratio on this metric, then this is actually a short-sighted short-term thinking decision, because short-term you're making the business look better, but long-term it's going to look worse. Moving on. If we think about how you could model Lemonade as a company, or most late-stage tech companies, they can be sort of split into two sub-companies that do two different sort of complementary things. So there's the customer acquisition machine, the part of the business that invests in sales and marketing that makes a clear ROI on the spend in the form of new cohorts of customers that generate future gross profits over time until an investment in customer acquisition cost is recouped. So there's part of the machine that's always funneling and fueling and buying new cohorts of customers. And then there's also the operations of the company. The operating company is the business investing in the longer term product. So you're making your products better. You're investing in engineering of those products. For Lemonade, you're building out the details of those products, further refining the products, making the claims process better for those products, making the customer acquisition support or customer support portions of the products better, all those sort of things. You're building out and growing and keeping those things running and improving them. Then that enables the company to keep fueling its customer acquisition machine. This sub business creates spends on product, engineering, finance, operations, etc. And when you remove customer acquisition from this machine Tech companies are awfully highly generative in nature. Gross profits from existing customers minus operating expenses here is often a positive number. This should not be surprising. The only reason tech companies look unprofitable is because they invest upfront in CAC today for a greater gross profit in the future. I'm going to flip over to my Lemonade model and pull up this graph, which shows adjusted EBITDA minus customer acquisition costs, and then I have it for this year 2025. It grayed out as sort of projected numbers. But you can see if you subtract your customer acquisition costs from adjusted EBITDA or adjusted EBIT CAC in a way, as they were sort of suggesting there, you can see by Q4 we were already positive. We're in the positive territory. Q1 I'm predicting, these are projections, Q1 could go back to negative. There's going to probably have a worse loss ratio with the LA fires. But throughout the year, then getting it back into Q4 of this year, we go from maybe, positive 10, 11 million to 28 million. So not quite 3x, but somewhere in that territory is probably where, things could end up in terms of your adjusted EBITDA minus CAC growth year over year. And I expect this is going to sort of spring off the page as they continue to make heavy investments now and in the last 2 years. If you look at what's been spent on growth spend or customer acquisition cost spend, you can see this is really ramped up in the last few quarters, and this 2025 again, expect almost every quarter is going to be back high in this sort of 35 to 40 million or even higher range being spent each quarter. And so those investments that Lemonade's making right now, they make your EBITDA look worse, but EBITDA minus CAC is going to look really, really good. And then eventually, all those investments are going to catch up to themselves, and your adjusted EBITDA is going to look really, really good. But Lemonade's following this script entirely, where they'd say, hey, we have healthy LTV to CAC of at least 3 or more, and I've calculated and shown that in lots of videos. It's at least 3, maybe even 4, maybe even 5, and they're going to keep turning that crank as aggressively as possible, even though in the quarters now it's going to look worse to people in the market, because simply on an EBITDA basis, it's not going to look as good. If you look at just EBITDA on a quarter-by-quarter basis, you can see it's been slowly improving, but there's a little bit of lumpiness here. Part of that lumpiness is because their growth spend has been ramping up over the last few quarters. So again, you subtract out the growth spend, it's like a straight line straight up into the positive. If you look at it with the growth spend in there, it's not quite as clear. You look on a trailing 12-month basis, it's not quite as clear. And that's what the market's going to look at. The market's going to look at this graph and say, when are they really going to reach profitability? What's the big deal with this Lemonade? It doesn't really look that great. But we as investors here, following the channel, following the story, thinking closely and looking at the nuance, are saying, look, it's basically a trend line from this Q2 of 2023 straight up. And this, you can model this out. I think it's just going to keep accelerating out into the future, especially as they're spending lots on growth that's going to drive even more EBITDA in each quarter going forward. But again, the market's going to look at this graph or the trailing 12-month version of it and say, where's the improvement? It's not coming fast enough. And that's our advantage as investors. That's where we are going to make the fortune that I mentioned. So moving on, he says the right profitability framework for a growth business is to have a target EBIT CAC, not EBITDA, and to keep spending on CAC until marginal CAC equals LTV. So he's basically saying even if your LTV was just slightly higher than your customer acquisition cost, you could argue that you still should be making that investment. Or at least you should be doing that at least until you have a yield on CAC that makes sense for the business. So maybe they're at a LTV to CAC of 3, but then if they double their growth spend, maybe overall that drops to a 2.5, and then they double it, as you scale it higher. It's a function of the opportunities you have, and then for Lemonade, the amount of products they have and how many markets they have and the amount of cross-sell they have. All those sort of things play into that equation. But he's making the argument that even if you're just making a slight slight gain on what you're spending on customer acquisition costs, it's still probably worth doing that you could aggressively grow if you're still convinced that the ROI or the unit economics of that equation makes sense. This is versus, again, most companies constraining how much they spend on their customer acquisition just because they have a target EBITDA. They say they want to keep it above zero. And then he goes on in the article, he says, in traditional industrial world, to grow, you have to invest in more capacity. So if you have a big factory and you want to produce more widgets or more whatever it is, then you need more machines and more factory produce those widgets. So, and that requires more capital expenditures. But you wouldn't expense that CapEx when you make that investment. You capitalize it by creating an asset on your balance sheet and then depreciate it over its lifetime. The hard asset on the balance sheet means you can get financing for it. So in that way, they're saying, hey, now you own a new building. So a bank or somebody's going to write that check and look at that carefully and say, look, okay, yeah, this has value. Now you own this. We can get financing. It's really secure. The math makes sense. You're going to be able to make so many more widgets out of the new factory. So that makes sense. So the trade-off between the balance sheet constraint and the growth does not exist in the same way, or at least an efficient frontier that is much further out. But in the same way, LMND, they're spending all this money on customer acquisition cost, and like I showed in my last video about book value, in a way, those customers are coming on, they become an asset, even though accountants don't like that. They're not going to do that. They're not going to show that. But that's how you can think about it as a LMND investor. That's how I'm thinking about it. As these customers are coming in the door, they all have attached to them a certain lifetime value. Then that lifetime value is contributing to LMND's book value, is contributing to the amount of assets that they ultimately have as they continue to push and make that investment in the customer acquisition that's going to make returns for many, many, many years. And he says, we have convinced ourselves that tech businesses are asset light, which they are. I mean, you don't have many buildings or anything like that or actual brick and mortar infrastructure, but we did not emphasize that they are expense heavy. In other words, to grow, we invest in customer acquisition, which is expense on the P&L. And as a result, tech companies look unprofitable and asset light on paper, even though they're fundamentally very profitable and asset rich in the form of lifetime value. Again, as you think about these customers that are now all part of the LMND book of business. Imagine what the profitability of EBITDA of a traditional manufacturing business that's growing capacity fast would look like if it was expensing all of its CapEx instead of capitalizing it. So yeah, if you bought a new factory and then you were writing that off as an expense, well, it would look that quarter or that year look really, really, really bad. And if that's how you were as investors in the marketplace were thinking about it, it would look really bad. And if you compare that to LMND, maybe there's if LMND was a manufacturing company and they were, instead of building factories, they're acquiring customers, which they are doing. And every customer, they continue to buy and acquire these customers quarter after quarter, and they're ramping that up. It'd be like this manufacturing company ramping up the rate at which they build factories and then expensing all those factories directly into their P&L, which would make their EBITDA look really bad for all the time they're doing that growth. But of course, we know that all of those investments are going to pay themselves back very, very handsomely. Unfortunately, tech companies today, even large publicly traded ones, still fund almost all of their CAC using equity. So they're giving up equity, giving up shares in the company to grow the company. And they've tried to use corporate debt or variations as part of their capital stack, but they're not designed for growth, as they do not isolate the risk to the customer acquisition costs, instead encumber the entire business with risk in the event of underperformance and have full recourse to other parts of the business. This, again, it causes companies who have a conservative mindset and versus when they're managing their loan versus a growth mindset of maximizing and managing the ROI on their customer acquisition. So again, two outcomes: tech companies massively underinvest in growth versus what they should be spending and investing, and they generate in the end a lot less cash than they should be generating, as is tied up in the customer acquisition cost. He goes through an example here, but he says, this approach, to end off the article, to capital planning is how we believe one should build an enduring business, but today we find very few founders and CFOs operate this capital allocation mindset. Have founders become too content with benchmarking themselves to metrics that have little grounding in basic unit economics? I would say yes. Instead of assessing over short-term profitability, it's time to assess over long-term equity value. Amen. Can I get an amen? But this is what I'm talking about. Back to the original tweet. If you think about this and understand this, I really think what could make you a fortune. Again, not financial advice, but I think it's going to make me a fortune, and it's going to make many, many others a fortune. It's this simple idea. Maybe it's too simple for me, or maybe some of us, because I do not come from a finance background. I'm from an engineering background, so I'm naturally just driven to think about what are the unit economics of the business and what's really affecting that now and going to affect that over time. And so it seems obvious to me that, hey, if you just keep pushing and investing in growth, then your adjusted EBITDA is going to look worse right now. But if you factor out what you're spending on growth, then if you cut that out, it's going to look really, really great. And then that's only going to improve more and more and more over time as you continue to spend on growth, or even as you continue to ramp up on growth, if that growth is a profitable, expenditure. In my head, again, it seems really, really simple. I do wonder, though, I think a lot of people maybe from the insurance world that are, quote unquote insurance experts would have more difficulty understanding this concept and this idea of being able to grow so quickly, so heavily like Lemonade is doing. Thank you so much for watching. Remember, it's in the bag.